All right, we are going to take a look at some numbers this time. So we're going to look at our 40-year-old male. He wants the ability to pay in $100,000 per year. So going back to the information we covered in the last video, we're going to utilize minimum base premium. He wants to get that as low as possible because it eats up his initial cash value. Going to look at a term rider. We're going to look at the cost of the term rider based off the company's current rates and also their guaranteed rates. And specifically what that means is all insurance companies reserve the right to increase their term charges as time passes. So we want to disclose that. That way the client does not have any ill surprises saying, I thought this was the term cost. Why did it go up? We want to show that up front. Important to do this in the industry. And then a MEC limit of at least $100,000. You're going to see that overinflated a little bit as well. So he wants maximum cash value. We're going to show you just how to get that. He also wants maximum flexibility. So many times we hear, hey, I want the ability to pay in $100,000, but again, I don't want to get a bill for that. So how this policy will be designed, we're going to see two variations, but the one that we'd recommend is set up in this manner. So the premium, the base premium, will be about $9,100 plus the term cost of approximately $900. And then we're going to allocate $90,000 into our paid up additions rider, which will do what? Accelerate the initial cash value, and long term, when you compare the two samples, you'll see as well. So we're going to look at one policy with a term insurance rider. We're also going to look at a policy with a higher base premium. We drove it as low as we possibly could without a term insurance rider, which is a good thing to look at because it is true that term insurance is a pure cost. Granted, it is very low, and in my opinion, it is the best way to reduce expenses and allocate more funds into cash value. We use these for individuals in their 70s, and it gives them the strongest guaranteed and non-guaranteed cash values, so it's very, very effective. But again, it's good to see this up front if we are interested in a policy. If you are an agent, our agent training program shows you exactly how to design all of this as well. And then you, of course, work with us in your business as far as modeling policies and then how to build a business as well. So last thing he wants to see, show me the guaranteed values. Have you ever felt like that when you're trying to look at different policy options and you say, hey, I read online, or my friend told me, or my financial advisor said, if you consider whole life insurance, just make sure that you look at the guaranteed values. I'll let you know when we set policies up for corporations or a bank, they're looking at the guaranteed values. Yes, they'll look at the non-guaranteed values based off the company's present rates as well, their dividend rate, whatever it might be. However, they are looking at the guaranteed values and they put a lot of emphasis on them because it's important. It's a guarantee. What is the worst case scenario? So let's get into it here. What we've got, 40-year-old male funding $100,000 for 7 years. Now, 7 years is kind of an oddball number. Where this example came from really has to do with his desire to fund up to the MEC limit. Another name for the MEC limit is our 7-pay test. And really what this has to do with is the first 7 years of a life insurance policy, where, call it, the vice grips are very tight on life insurance policies, vice grips from the IRS. They closely examine the death benefit and they say, hey, here's your death benefit and this gives you a MEC limit of X amount. After the first 7 years, it does change your MEC limit. The policy design is critical to determine if that MEC limit will stay the same or if it will decrease. In many examples, it decreases over time. But that's a great topic for another video or discussion. We've got some material on that. Point being, we funded this example for 7 years. We could go longer if we wanted to. So, the example on the left, here's what we got. 1090 split. Now specifically here, we see a base premium of $9,100 due for 7 years. Here's our term insurance cost. So the first year, we see that it is what? $899. In fact, let's tweak this real quick. All right, so here we go. Base premium, $9,100 per year for 7 years. Term rider cost, $899. Paid up additions payment, first year, $90,000. Total out of pocket, $100K. This cleanly breaks down where your money is going. You wanted the ability to pay in $100,000 per year, what you are committed to, minimum base premium, and the term cost, so just about a clean $10,000 initially. And then the PUA rider, depending on the insurance company, that can be added at discretion, one time per year. But the main thing is when we set the policy up, we want to set it up in a manner where medical underwriting is not required. This way you can adjust payments, bounce them up and down over time, and you don't feel like it's a fixed bill where you keep paying the same amount every month or every year. That's boring. We don't want that. So have the breakdown there, total out of pocket, $100,000 for 7 years. Here's the thing. So remember the last video, we talked about cash value somewhere between that 80 and 90% range. Right off the bat, we are very, very close to 89%. We're at 88.6. $88,601 is what we have in cash value in the first year. What is highlighted in yellow represents the break-even point, meaning by year 3, we are oh so close. We've paid in $300,000 and we have $295. By year 4, we've paid in $400 total out of pocket and we have $407 and change. So it's starting to compound and get stronger and stronger. Over here, we have a breakdown of how the policy was constructed. Net death benefit, but then you see a whole life insurance death benefit and a term rider as well. How we set this policy up is as you pay money into a whole life insurance policy, the base premium does gradually grow your whole life death benefit over time if dividends are paid, but adding funds into PUAs, the term PUA rider stands for paid up additions rider, meaning it's purchasing us paid up additional death benefit, whole life insurance. So this is why our whole life death benefit is going up. Even though we're doing this for cash value, it does purchase us more death benefit. As the whole life goes up, the term comes down, keeping you level at the 3.15 until we eliminated the premium. Why we see a drop in death benefit is we executed a transaction called a reduced paid up. Throwing a lot of information at you. Let's slow down a little bit here. So a lot going on there. Main point, juiced for maximum cash value. And then here we have the average internal rate of return. Why I like this is this displays what we are actually earning on our cash value life insurance policy. Because we can have a policy that has a dividend rate of 5%, 5.5%, 6%. Maybe it's a indexed product and we've got all these assumptions. But when you actually do the math, you look at it and say, this is not adding up. Like, why not? It drives me nuts sometimes, right? You might have felt like that. If I've got a dividend rate of 6%, the net internal rate of return, net performance after the company's insurance expenses, mortality charges, all of that stuff, the internal rate of return represents the actual growth on cash value. Here it is, the average. Average factors in the early years with a negative hit as well. So first year, here's the reason why anyone would not do this too. No matter how well you design a policy, there's our negative hit in the first year. We paid in $100,000. You've got 88 and change, which is great, and a sizable death benefit, but we've got a negative 11.4% return on cash value. That's a hit. No matter how we slice it, what the company's dividend rate is, that's a hit. Now, it does get better and better over time. We often state what? The performance of these policies over time will likely fall somewhere between 3.5% and 5.5% based on historical performance and actual data. This is just an illustration that tops out about 4.6, almost 4.65%. Not bad. This can be tweaked a bit to be improved. I'll add that. But at the same time, it falls in the neighborhood, in the range of that 3.5 to 5.5% range. No risk, not invest in the stock market, don't have to worry about it. It's a hands-off approach in a lot of ways. That's why so many individuals like this as an alternative to just stockpiling funds in a bank account. So let's look at a policy without a term rider. So we see no term rider attached. So same 40-year-old male, same insurance company. The base premium is just about 33%. I squeezed this as low as possible without having a term insurance rider. So it's $32,800 with the PUAs paid in as well. Death benefit is just about $2.8 million. Right? So if you're in the industry, if you're an insurance agent and you have illustration software, if you were to go on your software and plug in 2.8 for a 40-year-old male, health rating does not matter, you'd see a MEC limit of just about $100,000. Doesn't matter how you blend the policy. Point being, we maximized this based off of not having a term insurance rider. So minimum base premium, kept the funding apples to apples, 7 years. PUA rider, just about $67,000. Total out of pocket, $100 per year. Here's the hit. That base premium is not showing up in cash value right off the bat. Same thing with the max funded policy. $100,000 in, why do you think we had that negative 11% return on cash value? Because of the base premium. We're purchasing a life insurance policy. Even if we say, I don't care about the life insurance, it is a life insurance policy. Same thing over here, but because we did not have a term rider attached, we were forced to raise the base premium. We're at about 2.8 in death benefit, which again, this just gives us a MEC limit of 100K. Takes about 7 years to break even now. By year 7, I've made collective or total payments of $700,000, and I have $705,000 to be precise. So again, same company here, same health rating. Let's look at it over time. This is where it gets oh so interesting. Right, how far down do we want to go? It doesn't really matter. Let's look 50 years down the road. He's almost 90 years old at that point in time. 5.6 million on the initial policy designed with a minimum premium, maximum cash value. Average internal rate of return, a little over 4.5%. And again, average factors in the fact that we took a negative hit in the early years. If we look at the annual return, it's a bit stronger than that. Example on the right, with the higher base premium, less cash value off the bat. Look at that. About $540,000, same insurance company and dividend assumption here, by the way. Like, nothing different there. Internal rate of return, a little more than 20 basis points less. So that's where, in a testament to the policy design, understanding that and knowing where our money is going is important. And again, if you worked with us or considering working with us, or if you want to, call, text, email us anytime. But this is the kind of stuff that we show you. If you say, hey, I get it, just show me the numbers, or I want to walk through it, understand it in and out, this is typically step one. And then once the policy is designed and set up for maximum cash value, step two is showing you how to use it. Whether it's, hey, I just want to let it sit and grow, use it in retirement, or if I want to borrow, repay, use it for loans, wipe out debt, purchase real estate, whatever it might be, using it step two. That's where it gets fun, if you don't consider all of this stuff fun. So this is based off the company's present dividend rate, present expenses and such. Let's look at the guarantees next. So always good to look at the guarantees from an expectation standpoint. It sets things properly, because what happens so much in this industry is everyone shows the best numbers out of an attempt to win the sale, really, and I get that 100%, but if we show the best numbers and it under delivers, what ends up happening here? That's where the consumer is unhappy and said, wait a minute, I thought I was going to have more money. This is your money you're paying into a policy. We want to make sure it's maximized. If we don't want all of the details, if you say, hey, just show me the important bullet points, looking at the last slide we looked at, best case scenario is good. Also look at the worst case scenario. Perhaps peg it somewhere in the middle, which we can show that as well. Point being, seeing that up front will set expectations and prevent buyer's remorse. Not seeing that up front, like if I show you the best and then it doesn't do that, that's where disappointment can come into the equation. So here we go, 1090 split, setup exactly the same. It's the same policy, we just stripped everything down here. Term rider cost, now you will notice a difference here. Term rider cost is the same for the first and second year, then it jumps up. Even though the term rider amount is coming down, look at the term rider cost over here. It spikes in year 3. The reason why is this assumption with this particular insurance company assumes the company's charging the guaranteed maximum for their term insurance rider. So every company reserves the right, again, to increase their term rider costs. We did just that here. The first 2 years, regardless if the policy is guaranteed on the term expenses or non-guaranteed, they're identical. Once you hit year 3 is where it can jump up. This doesn't, I haven't seen this happen, but let's assume it does. So we raised the expenses, we slashed all the dividends, only look at the guaranteed rate of 4%. And what do we got? Break even point, year 6. We've paid in $600,000. We have $600,000. Now, if you've ever seen a whole life insurance policy where you're paying this money in, it takes 10, 12, 14 years to break even based on the non-guarantees, and then you got an absolute worst case scenario, you're breaking even year 6, that's the policy design. This is where this stuff gets fun, if you're an insurance nerd like me. So, term cost keeps coming down, net death benefit over here. And then we've got the same thing that we looked at with no term insurance rider. Death benefit, identical right off the bat. Again, 2.8 million. Why do we have it there? MEC limit, $100,000 MEC limit. This guy's a little bit overinflated. It's about a $114,000 MEC limit on the left. So, same thing, but look at this. Even though those term costs are maximized, when's our break-even point? We've paid in $700,000 and we get our $700,000 back year 7. Year 10. That's a long time, right? This is our money again we're paying in. Whether it's $100,000, I know that's a lot, maybe it's $10,000, maybe it's $1 million per year. Whatever the dollar figures are, we want to see the different options up front so we've got transparency and then we can select the option that fits our situation the best based on whatever we're trying to accomplish. Cash value difference on the right. So this is just comparing here, these two. Again, same company, same individual, same age. Which one gives me more money? Pretty clear. The example on the left. So know this was a lot of information. Going back to the drawing board, the purpose of this was to equip us with the knowledge we need in order to maximize the cash value and understand where our money is going. Quick recap. If we pay money in, how much cash value should you have in the first year? Somewhere between 80, 90%, breaking even between years 3 and 5. Why the range exists is due to the insurance company and products selected. And then the main areas, premium, term rider, PUA rider, and then I've got the MEC limit as well. Hope this helps. If you have any questions, reach out anytime and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.